Hey friends, Heather here with episode 3 of Building a Better Business. Thank you so much for joining me and hopefully learning some tools to help you build that business of your dreams. This week's episode is by special request. What can I deduct on my taxes? So when I posted episode 1 a couple of weeks ago about your tax filing deadlines, I had a special request for this one. So shout out to Amy. This one is for you. P.S. If you have any special requests, just pop them into the comment box. I love requests. I love hearing your thoughts. I'm going to start off by saying that this episode is going to be long. It's going to be double what I usually do, so I hope you make it to the end. It's packed with information. If your brain starts to explode, use the power of the internet. Hit pause, go watch a few cat videos, and then come back when you've let some of that stress go. Now, if you did miss any of the previous episodes, you can always head over to my website, prosperityflowcoaching.com, and go into the Build a Better Business blog page. Or you can head over to my Facebook page, Prosperity Flow Coaching. I've pinned a link at the top that will take you over to the YouTube playlist. All of the episodes are going to be living up there on YouTube, so you can check back on them anytime. And we know the internet is forever. So anytime you need to refresh your memory, just head back there. Now, while I'm at it, don't forget to subscribe so you don't miss any episodes. They're coming out every week. So on to today's topic. This is a really big topic. Everyone always is interested in what can I deduct on my taxes. So I'm going to start by saying there is no way I could possibly come up with every single item you may or may not be able to deduct. That would be insane. But I'm going to go over the general guiding principle the government uses when they're trying to decide deductibility. I'm going to talk about some of the main things you can deduct and some of the common errors that people make as well. So I'll say again, this is going to be for sole proprietors and partnerships. I'm assuming if you're incorporated, you already have an accountant helping you out, which is awesome, and the corporate tax thing. So the first thing I'm going to talk about, right? This is important, and this is a thing you need to remember. This is the touch point for anything that you are considering adding to your expenses. This is the thing CRA uses as their benchmark, and I'm going to actually read you an excerpt from the Income Tax Act. Then I'm going to explain it, since it's not written in a way that makes it easy to understand. So Section 18, Paragraph 1, in computing the income of a taxpayer from a business or property, no deductions shall be made in respect of an outlay or expense, except to the extent that it was made or incurred by the taxpayer for the purpose of gaining or producing income from the business or property. I know, I feel your pain. When I was in university, I was studying the Income Tax Act, and it has those thin tissue paper-like pages so they can jam in all kinds of information into one book. And I fell asleep with my face planted on the Income Tax Act, and I had that sleep drool. So when I woke up and I peeled my face off of the Income Tax Act, all the pages were stuck together. Let's just say it wasn't pretty. So I know, tax is not all that exciting, but it's trying to tell you stuff. So what does it mean? It's all the double negatives and legalese that makes it confusing, but it's super simple. What they're saying is you can only deduct something if you spent it for the purpose of earning income from your business. Easy, right? So I can hear some of you now saying that you spend everything on your business. And yes, you may think about your business while you're away on vacation, lying on the beach in Mexico, but that money is not really spent for the purpose of earning income from your business. That's why they have this big, thick Income Tax Act, and they get into specifics on certain things. So great, we know this. You can generally deduct expenses incurred in the course of doing business, since obviously you're doing them to generate revenue, right? So some things are going to be pretty clear. Rent, clinic supplies, office supplies, utilities, phone, advertising, insurance, salaries, repairs, maintenance, as long as it's not capital. Talk about that. Legal, accounting, maybe other professional fees that you're paying. If you're in Ontario, your CMTO dues, maybe you belong to the RMTAO, so dues like that. A lot of these are super obvious. Okay, so now let's get into some of the quirky things. The first big thing I want to mention is about the HST. If you're registered for the HST, this means you're collecting HST from your clients on all your taxable revenues. It also means that you are claiming HST that you've paid on your expenses as an input tax credit when you prepare your HST return. So don't worry, an HST video is in the works, but it's a huge subject all by itself, so it kind of needs its own video. So basically what I'm trying to say is if you're registered for the HST, that means you cannot deduct the HST you included in your expenses on your income tax return because you already claimed it on your HST return. So for example, let's say you pay $1,130 in rent. Obviously, you're not in Toronto, it's just an illustration, but you physically pay $1,130 in rent, and commercial rents pretty much 100% of the time have HST included. I actually have never seen one that hasn't. So on your HST return, you would have put the $130, which is the tax amount, against the HST you collected when you submitted your HST return to the government. Therefore, only $1,000 of your rent is business expense for your income tax return. So to make your life easy and not make you crazy, just set up your bookkeeping system to keep track of these things separately. And make sure you go back if you need to listen to that again. So let's go over that. If you're registered for and collecting the HST, you can't include the HST in your expenses on your income tax return. Got it? Okay, wages, easy, right? So if you have staff, then you have payroll expenses. Chances are if you have staff, you also have an accountant type person helping you. Wages and the deductions that you pay to your employees are deductible for your taxes, but not wages paid to you. You are the business owner. It's your business, and that'd be like taking money from one pocket and putting it into the other. You're going to pay tax on your net income, and paying yourself is not going to lower your income. Sorry. Now, if you pay your spouse or maybe a child and you have them on your payroll, there are a couple special stipulations in the Tax Act. First, you actually have to pay them. So not just on paper pay them, you physically have to pay them with a check or deposit. Second, the work they do has to be necessary to the running of your business. So not some made up position that you've got, it has to be an actual position. And the wage has to be reasonable. So when they say reasonable, they mean the wage is what you would pay someone else if you hired them. Also, in the case of a child, you need to consider if it's reasonable given the child's age. So you can't go out and hire your 3-year-old, pay them $50,000 a year, and claim they are answering phones for you. Right? Right. So somewhat related to wages, many clinics hire contractors. So that one's pretty easy and straightforward. You deduct what you pay to the contractors. But just don't forget, don't include the HST portion that a subcontractor might charge you on their invoice if you're registered for the HST. Okay, so the next one might be a new one. You might not have ever heard of it, bad debts. So do you have an amount that is owed to you for some reason or another you're likely never going to receive? So these are amounts that you've already included in your income, maybe last year, maybe this year. They're in your income, but you're never going to get paid. So maybe something like you took a check and it bounced, or you did a direct insurance bill, it didn't go through, the client was already gone, you never see the client again, they're not responding, maybe they've vanished off the face of the planet, it happens. That's what's known in the accounting world as a bad debt. So you can claim it as an expense without the HST, as long as you've included it already as income this year or previously, right? Right. Another special case you might encounter if you have a new business. So if you start a brand new business, the Canada Revenue allows you to deduct your startup costs as an allowable business expense. Now, the businesses have to be incurred after the day your business commences to qualify for this deduction. So startup costs for your business can include anything that you need to get your business going. So maybe it's supplies, renovations, building a website. If you're setting up a clinic space, maybe things like your first month's rent, display stands for products, signage. All of these expenses are very likely startup. But to claim them as business expenses, you need to incur them in the fiscal period that you're carrying on your business. You might not be earning revenue yet, but you have to incur them And you have to incur them the day before your business actually starts. So your start date isn't necessarily the day that you're earning revenue and seeing your clients. It's a day when you commence significant activity that's a regular part of your business trying to make profits. So maybe the day you physically open the doors, or maybe the day you start taking bookings, even if you haven't opened your doors yet. That's, they would consider that business would have commenced. They also consider it commenced when the owner is taking actions to introduce their product or service to the market. So in the clinic example, if you're opening a clinic, the day you first start trying to find a spot for your clinic could be the day your business commenced. So maybe your expenses started then. What you really need to know here is if you incurred expenses before your business started making any revenue, it's likely that you can still deduct those expenses, and those would follow under startup expenses, right? A quick note under membership dues. You already know you can deduct your professional membership, maybe membership in a trade or commercial association, but you cannot deduct club memberships if the main purpose of the club is dining, recreation, or sport. No gym memberships. I know. The massage therapist work is physical. I actually go to the gym myself to stay in shape for my job, but no deduction. It gets specifically excluded. In the somewhat related category, meals and entertainment expenses can be deducted, but there are rules here, and we got to think about that general principle about the expense being incurred to generate revenue. Things like buying your lunch every day while you're at the clinic don't count. Now, if you have to go to an offsite course or an offsite meeting, perhaps you are offsite at a convention, those are deductible, but only 50% of the pre-HST is deductible. This is because they know you were going to eat anyway. So eating in this case is not entirely for generating income. Then there's one more thing. They make a very specific point of saying the amount you can claim is the lesser of the amount paid or an amount reasonable in the circumstances. That means if you're away at a training or a client dinner or a meeting, offsite meeting or something, you cannot order the $500 bottle of champagne and write it off as a business expense if it's not normal in the course of your business. Now, where maybe you're having a staff party, so food for your staff party, or if you provide coffee or tea in the office, that is deductible, even if it's in your business space. So side note, you're only allowed to have 6 staff parties a year. You're only allowed to expense 6 staff parties a year. Really what they're trying to do here is just stop you from expensing your everyday meals as a business expense because they know you're going to eat anyway. Still under the entertainment category, CRA includes things like tickets, entrance fees to an entertainment or sporting event, gratuities, covered charges, hospitality suites for functions. All of those fall under entertainment. That's the 50%. And if you're wondering, if you're confused and you don't know whether to claim it or not, just do a little search under CRA. Look under meals and entertainment service for self-employed. Maybe check back to episode 2 from last week and maybe hire some help if you've got a lot of problem with confusion. So, and still on the meals topic, sometimes travel is deductible, but sometimes when you're traveling away from your workplace, you end up with it mixed together. Meals are included. Somehow you have to pull out the meal portion of that travel cost because the meals are only eligible for the 50% while the travel is 100%. And being able to expense travel, by the way, doesn't mean you get to claim traveling back and forth to the office. That's not included. Paying for a parking at the office isn't included unless the parking spot is somehow included in your commercial rent. I mean, that's different than paying to park on the street. So when you're expensing travel, it's away from your normal place of business. So meals, travel, those kinds of entertainment, those are where people get hung up a lot. So that's where they get caught quite often. So follow the intent of your regulation. And if you're in doubt, just get some help. Changing gears, under the insurance category, obviously you get to deduct your clinic insurance and your professional insurance. Does not include car insurance. If you have a vehicle, all of your vehicle expenses are going to be held separately. Anything that you incur for your motor vehicle should be kept separate. Fuel, insurance, maintenance, all of those things. So vehicle expenses are handled separately, since if you want to claim vehicle expenses, you have to track a mileage log, business versus personal, and the proportion related to business is what you deduct. Driving back and forth to your office is not business mileage. Also, if you're claiming insurance, you cannot include any portion of your home insurance. If you have a home office, that goes under the home office expenses. Speaking of home offices, a whole new piece, you can deduct expenses for the business use of a workspace in your home if you meet one of two criteria. The first criteria, it's your principal place of business. So this is pretty clear, right? It's your only space for seeing clients. It's in your home, so you can deduct home office expenses. And it's the proportion of the space that you use for your home office. The second criteria, which may fit you, maybe you work somewhere else, but there's a space in your home that you use to earn income on a regular or ongoing basis. Maybe you're meeting clients, customers, patients. Maybe you're doing work in your home office that's not your regular place. You still need to calculate the proportion of your home that you use for business, and then you take that proportion of your home office expenses, maintenance, heat, home insurance, electricity, property taxes, mortgage interest, capital cost allowance. So the proportion that's used for work, you claim as a home office expense. Now, if you don't use it 100% dedicated to your business, you could still use part of your home for your business, right? So maybe you've got a spare room that's partly your office and partly a spare room. So you calculate how many hours you use in the day for your home office, and then you divide it by 24, and then you multiply that by the proportion of expenses that are for business. If you only run the business part of the week or maybe part of the year, you just reduce it by how much you're actually physically using the space. My recommendation on this part, don't try to be aggressive with your expenses. Be honest. How much do you actually use your home office? If it's the kids' playroom or a spare room and you happen to have a desk in there that you might visit every now and then, be honest. Don't try to claim a huge expense. It's better to be honest and pay the taxes than be reassessed if CRA decides they look at your tax return and they think it's unreasonable for what's running in your business. Another thing, if you do a large renovation or you purchase something new or substantial, say a new electric massage table or a new computer, these kinds of expenses don't go direct into your tax return. So anything that provides a longer life than a year, something that's over a number of years, is capitalized. That means it sits on your balance sheet. It's not expensed in your income statement immediately. So each year you take a piece of that big expense over time and add it into and take it off your income statement. It's depreciation. CRA calls it a capital cost allowance. And there's a variety of categories depending on what type of asset it is. So you can do a search online in the government site. Just search under classes of depreciable property. Scroll through the list and find what you're looking for. I'll let you know, class 8 is generally office type, desks and furniture. Computers are generally class 52. Another thing, in the first year you buy something, there is something called the half-year rule. So say class 8. So class 8 is 20%. So you take 20% of the amount on the balance sheet every year, except in the year that you buy it. Half-year rule, you only get to deduct half of the 20%. So basically 10%. I will never, ever forget the half-year rule as long as I live. When I was writing my CA exams, I can see it like it was yesterday. I forgot that rule on my exam, and when I was driving home was when I remembered it, and I almost drove off the road. I'm happy to say I passed. It was only a small error, but it's just one of those things that sticks in your head forever. Okay, so there's a lot of stuff in there. I know I didn't cover everything, and I know it was a lot, and it was kind of going fast, and it was confusing possibly. Let it sink in. Press pause. Go back. Do a bit of research. Do a bit of thinking. Go back and replay it. If you get tense, just pause. Take a breath. It's okay. I covered a pretty good chunk of what usually comes up. I tried to cover where I thought you might make some mistakes, but don't let it make you crazy. Just remember what the principles are. Reasonable expense for earning income, and then you'll be fine. I hope you found this video helpful. If you did, give me a heck yeah in the comments. Give me a like, maybe share it with your friends. Don't forget to subscribe to the YouTube channel so you don't miss any episodes. If you missed that free tax checklist that I gave away in episode 1, I'm going to include that link below. So you can go ahead and grab that if you still need it. And get ready for next week. So not as heavy as this week. It'll hopefully still on our taxation theme. I'm going to be looking at various do-it-yourself tax programs out there, some that I've used, some that I've heard about. I'm going to take a look at them and give you some ideas on easy ways that you can do your own taxes. And as always, I love hearing your ideas, questions, comments. Feel free to drop me a line. So until next week, I'm Heather. My business is Prosperity Flow Coaching, and I am working hard to help people who help people. I hope you have a great week.